please take it away.
All right, Jim, thank you, and thank you all for being here tonight. We'll cover a lot of territory tonight, and it's always difficult to know how deep and wide to go when you come to endowments. I was at a church on Sunday, met with the endowment committee, and we spent an hour and a half of conversation, and we were just beginning. So this has many, many aspects to it. We welcome you to ask questions during the conversation tonight. Enter it into the chat mode. And if we don't answer your question online in the conversation tonight, please let me know that we will send a response to you by email. Also, following this seminar or webinar, we will be sending all of you a copy of our sample endowment policies and guidelines. This is a very popular document. It's been used in hundreds of Episcopal churches to establish and to refine endowment policies. And I'm happy to go through that with individual churches and meet through Skype or other means to help churches get that structure in place. So, little background. But in a broad view, I'm saying endowments, I believe, are going to play an increasingly important role in the future of our churches. And for many churches, they already are playing that role. The volume of calls I get, the number of emails I get every day are witness to the amount of interest there is today in endowments. Endowments are unique creations. They reflect the generosity of past generations. They challenge the skill of the current generation to manage the endowment or the resources effectively and responsibly. And they invite congregations to vision the future as what this church might be like 10 years, 20 years, 30 years down the road. If you don't have an endowment in place, and perhaps some of you don't tonight, and that's why you're here, I would say you're committing two sins at once. That's a little severe, but I think it's true. One is you're depriving your church of important resources for ministry that you could have otherwise have, and you're depriving your parishioners of an opportunity to make a meaningful legacy gift to your church. One of the mantras that I have carried around the Episcopal Church when I'm in diocese, particularly, is that every church, no matter how small, and no matter if they have a dime of endowment money or not, needs to have endowment structure in place. If you don't have an endowment structure in place, the opportunities, the chance that you're going to receive endowment funds is relatively small. And for churches that have a well-organized endowment in place, your job is to see that that legacy continues. So tonight we're going to talk about endowments. What is an endowment? Why have one? What principles support a well-managed endowment? And what operating policies do you need to have in place? I think we all agree on the importance of endowments. Let's talk about how to make that happen. I'm going to start by talking about 4 core principles, and I'm going to illustrate it with bad examples. And I think I seem to be able to come up with a lot of bad examples more often, but they're the ones that stick in your mind, you know? And the examples are pointing out the core principles of purpose, perpetuity, prudent investing, and prudent spending. A church called me recently and asked me, given the size of their congregation and their annual budget, how large should their endowment be? Did I have a rule of thumb to match up their endowment size to their church? And my answer was a question. If you're using the endowment to supplement the annual operating budget of the parish, the answer is pretty obvious. All you have to do is to get an average value of the fund over 3 years, multiply it by 3, 4, 5%, come up with a number, and is that sufficient for what you need to supplement the annual operating budget? If not, you need to increase your endowment. But that's not what endowments are about. What's the point? What's the purpose? If the endowment is to be used for something other than propping up the annual budget, then there's no limit to the size, nor is there any argument as to whether or not it's diminishing annual stewardship. point is perpetuity. Endowment, by its very name, implies perpetuity. Yet there are far too many churches that are currently spending down their endowment to meet their current operating expenses. It's a difficult time for some churches. I recently met with a church that had about a $600,000 endowment. They decided they wanted to increase their endowment. That was $600,000 several years ago. They wanted to increase their endowments. They went back to the donors and asked them to contribute again. And of course, the donors asked, well, what happened to the $600,000? Well, it was now $300,000. And what had happened was they had come up short on annual operating budget. They had dipped into the corpus of the endowment and spent that down. So it's no wonder that the donors were rather skeptical. Third point is prudent investing. One of our churches was invested largely in equities back in 2007, 2008. And as you know, that was the time when the market crashed. And they saw their resources diminish significantly during late 2007, 2008. And by the end of 2008, 2009, January, they came to me and said, we cannot take it anymore. We can't stand it. We're losing too much money. We want to change our investment from 80% equities to all cash. And that was in January of 2009. And no matter what I said to them, they said, no, we have to do it. They did it. They were invested in cash, which, as you know, is earning oftentimes less than 1%, whereas the equity market in the 50-50 blend that year, that is, our 50-50 pool, was up 21%. So they rode the market all the way down. They had no return in what they did. And they were able to do that because they didn't have an investment policy statement in place which restrained them from making these radical emotional moves. And the third point is about prudent spending. There was a church I talked to several years ago that said that they felt endowments were there to be spent, and that rather than spend the typical 3 to 5%, they were going to spend more than that. They were going to spend 10 to 12% each year, and they were going to make it up through fundraising. I got a call from the vestry a couple of years later, 3 years later, and what had been a $6 million endowment was now $2 million and rapidly falling. And what had happened, they were spending 20 to 25% of their endowment to prop up their annual operating budget, and they were in deep trouble, and they are in deep trouble today. So 4 stories about principles of endowment that we all need to think about from time to time. The purpose, the fact of perpetuity, the prudent investing, the prudent spending. We're going to step back for a minute and consider what an endowment is and what it is not. First off, an endowment is a long-term fund set aside with restrictions and invested to provide a reliable source of income to your church over time, and only a portion is spent each year. Long-term funds, restrictions, portion spent in any year. Generally, there are 2 types of endowments. There is a true endowment, which is donor restricted, and there is a board or quasi-endowment. The true endowment is generated in two ways. If a donor gives a gift to your church endowment or gives it to the church and says, I want this to be held in perpetuity, you have a true endowment, and you're required by law to fulfill the terms of that gift in perpetuity. The second way you can have a true endowment is if the church itself promotes whatever fund they're promoting and says, this is a true endowment. If you give to this, we're going to hold that fund in perpetuity. That's equally restricted as if a donor had given you that in the original gift. I want to point out here that the state has an interest in all nonprofit endowment funds that are restricted, that is donor restricted. That is, there's a law called UPMIFA, U-P-M-I-F-A, the Uniform Prudent Management of Institutional Funds Act. It's passed in 49 of 50 states. It's a template law. It's a little bit different in each state, but the core principles are the same. And it applies to donor restricted funds. and it has various guidance with regard to investing, and it has guidance with regard to spending. And it's something that you would want to look at if any of your funds are restricted. And you can look up the law in your particular state and go to www.upmifa.org. And all of our policies that we offer do reflect the principles that are embedded in that UPMIFA law. A quasi-endowment is if the governing board, in this case the vestry, sets aside unrestricted funds. That could be from the sale of property. It could be from an unrestricted bequest that came to the church. It could be excess cash. Those are all pots of money that the vestry could decide to spend in the current year, or they can decide to put it in the endowment fund. If they choose to put those funds into the endowment, they remain unrestricted funds now and forever. You cannot make an unrestricted fund, an endowment fund, a restricted fund. So most vestries, when they decide to put unrestricted funds into an endowment, they intend to manage it as if it were a true endowment, that is, to protect the corpus and not spend down the principal. But the reality is that no current vestry can restrict future vestries. So some other vestry of the future could get in and spend down the corpus of the unrestricted endowment, and which is why we include in the sample policies what I call the 2/3 times 2 times 2/3 rule. And what that is we say that if the vestry decides it wants to spend down the unrestricted endowment funds beyond the annual spending rule, that it's going to require 2/3 vote of the vestry at 2 consecutive meetings and 2/3 vote of the full congregation. That way you have full transparency and you make it a barrier fairly high, I would say, to spend down the unrestricted portion, because the intention is to keep that money there in perpetuity. In our sample policies, we do allow for this spending down of the unrestricted endowment because under certain circumstances there may be the need, but we do set the bar high for vestries enabling to access these funds. Let me tell you what I would say an endowment is not. It's not a collection of trusts. I was at a church in Virginia, and we were talking with the endowment committee, actually it was the investment or the vestry, and I said, if I wanted to give a gift to your church endowment, how would I do it? Well, first they said they had an endowment. I said, great. I said, how would I give to it? And they were puzzled over that question, because what they had were several trusts which really couldn't be added to. So they didn't have an endowment. They had a collection of old trusts that were kicking off revenue for the church, but there was no new money able to come in. They're not short-term reserve funds. Reserve funds, say, for an organ or kitchen improvement, these are short-term funds that you may not spend for a year or two, but it does not have a long-term time horizon, so they shouldn't be invested collectively with your endowment funds. And those that did that learned, sadly, during the 2008 downturn that their reserve funds were seriously depleted, and they didn't intend that. Thirdly, they are not invested funds. Some churches will have an investment, the excess funds, they decided to invest them, but they don't have the rules, the purposes, the structure built around them. So they're totally vulnerable to the vestry to spend down at will. And some vestries prefer that. But there was a church that we managed. They have about $3 million with us. And a vestry member came to me and asked me, could they start a true endowment? And I said, surely, you can. You simply need to identify it as such when you invite gifts to it. But the larger question at that particular church was, what was the need? Why have an endowment? Why build this up? There are people who are clearly able to make legacy gifts to the church, but the church needs to make a case for why they're worthy of a legacy gift and how they would use that legacy gift in the long term. It was a well-resourced parish, so they didn't need the money for their own purposes. They needed to come up with a reason for why they should have an endowment at all. And we're going down there actually in November and having a conversation with them. The question of why have an endowment fund at all, I want to slip that in there, Jim, before I go to why investments don't grow. Financial independence is often a purpose of nonprofit organizations. When they establish an endowment, they say we want to establish financial independence. But I would argue that a church seeking financial independence is really undermining the very reason for its existence. You want to have an endowment that empowers ministry, that looks to the future, and that not necessarily a savings account to protect against future uncertainties. And we use the words to define that vision, such as the endowment fund is a means to enable the church to fulfill its ministry beyond what is possible through the annual operating budget. When the only purpose of an endowment is to support the operating budget of the church, it will sap the strength of that church and often undermine the stewardship of that church. And when we use it as a God-given resource to do work beyond ourselves, we'll find that these endowments become blessings, and the more mission-oriented, the more additional gifts they receive. So what an endowment fund is not for. It is not used to be used to plug holes in the annual operating budget or underwrite the bulk of an annual operating budget. And a question sometimes comes up, well, should we use it for any part of the annual operating budget? And yes, some churches do need that. Some churches do it. But then where is that needle? I mean, there was a church I was with that 60% of their operating budget came from revenue out of the endowment. Well, that church was dying on the vine because it had no vision. And the stewardship was, I think it was at the bottom of the parishes giving in that diocese. But should any of it be used for the annual operating budget? And I think that's a point to be discussed and talked about and determined in each individual case. It's not to be used as a savings fund to protect against future uncertainty. I would say it could become a crutch or excuse not to spend for ministry because who knows? Might need it someday. So let's just keep that there. It's out of fear. And it's also not to be used for self-preservation. I had a church in New England that called, and they were an older congregation. There were a number of parishioners that were dying, and they were concerned about the survival of the church. And so they said, we want to set up an endowment fund. I said, well, what's the purpose? Well, we want them to replace their pledges with endowments. I said, well, that's great, but picture what it's going to be like 20 years from now. And they hadn't thought about that. It's like, okay, 20 years from now, they're going to have a church with the lights on, the floor is clean, and there's nobody home. They needed to think about themselves a little differently. What an endowment is for is meant to be used to support ministries beyond what is possible in the annual operating budget. It's a means I call it the R&D, research and development of new and innovative ministries. What's the church going to be like? What's the community going to be like 20 years from now? And how is the church going to be positioned to respond to that? And the other purpose is to provide a well-woven basket, I would call it, to receive legacy gifts from donors who want to remember the church in their will. And this will be obvious because I've mentioned some of these in my bad examples, why endowments don't grow. Clearly the lack of structure, and I think that's something you all need to pay attention to and work on. Even those that have been around for a while need to take a good hard look at the structure of their endowment to make sure they have the current practices and policies in place. An outdated structure, same thing, or a structure that's considered like a series of trusts. A lack of trust, meaning that the vestry has spent down the endowment for purposes not agreed upon, or simply spent down the corpus when they needed to, and people no longer trust the vestry to manage their money. Unclear purposes, or just simply not having asked. Those are all reasons why some endowments don't grow. Structure, and I keep coming back to this, is such an important thing, and I work with a lot of churches, and I also say it's step one in any effective plan-giving program. You cannot ask people to give to an endowment without being able to explain how the money will be used, how it's going to be invested, how much is going to be spent every year, and who's in charge of making those decisions. First of all, you've got to define that broad vision, and that, I think, even could be an annual conversation within the committee, answering the what's the point question. What's the point of the endowment? Endowments, then, once you've described that or defined that general purpose, you want to understand the permanence, the perpetuity of it, and realize the difference between restricted and unrestricted funds. Then you define the purposes. And in the policies that we offer, we suggest several broad categories of purpose. We say purpose could be capital needs of the parish. It could be outreach ministry and new ministry, or gifts that are included that donors have designated for the church. And once you've made those core decisions, then you put them in writing. Too often, when I go to a church and talk about endowment policies, what we have are minutes of vestry meetings from 1996 or 2000. You need to have a set of policies in place that are current and are acted upon and that are talked about on a regular basis. Let me talk a little more about the enabling resolution. Let me go to the next slide here. These are the policies we suggest and the policies we will provide to you. The enabling resolution is the core structure that establishes the endowment. It defines the purposes. It sets up who's in charge. It talks about the restricted and unrestricted funds. It talks about how funds are dispersed from the endowment. It talks about how you change rules, how you walk into or get into the unrestricted part of the endowment. There's some other core principles that churches need to wrestle with at this point. One of them is whether you designate an endowment for a particular purpose. My bias is to keep the endowment general, have a general endowment for general purposes, as I described. Some churches have specific pockets. They'll say we want to have an endowment for music. We have an endowment for the rector's position. We want to have an endowment for Christian education, music. Those, you can do it that way, and it may capture some donors' particular interest, but what it is doing is tying the hands of future vestries, because once you receive those funds for those purposes, you're obligated to spend that money for those purposes now in perpetuity. So I would suggest that you try to keep them relatively broad, the purposes. There's another core principle within the enabling resolution which establishes a relationship between the vestry and the endowment committee. That is, the endowment committee is comprised of people who are not charged with the annual operating budget of the parish. That is, the rector, senior warden, and the treasurer are not voting members of the endowment committee. The endowment committee are members of the church, but not necessarily those responsible for the annual operating budget. And I think for obvious reasons, they have the long-term interest of this invested fund at heart, and they're not as concerned, or they are concerned, but they're not as involved in meeting that annual operating budget. There also builds in a sequence of how money comes out and the responsibilities of the two groups. That is, the endowment committee manages money. That is, it doesn't decide how the money is going to be used. It makes sure it's being used for the purposes agreed upon with the vestry. The vestry decides which funds, which projects get funded. And that's one of the things I've been worked at in several churches where we sorted that out, where the endowment committee felt it had a role to play in making a decision about how the funds get used. And it became rather difficult and conflicting when you have two groups with money in the same church making decisions about priorities of the church. It's the vestry that has to have the ultimate control about priorities. The endowment committee invests the money, manages the money, determines how much is going to be spent based on a spending rule, and tells the vestry, here's the amount of money available for expenditure in the coming year. That's all part of your enabling resolution. That sets up the framework in which you operate. And then there are 5 operating policies, which the endowment committee comes up with, or it can all be done at one time. One, of course, is the investment guidelines, investment policy statement. And I referred to the importance of that earlier when the church went from 80% equities to 0% equities. This sets the target asset allocation between equities and fixed income, and also defines what types of assets you will not invest in. It talks about what your goals are, what your risk tolerance is, those kind of things, which will help your investment manager effectively manage your endowment funds. There's a disposition of bequest policy. This becomes very important when you become a recipient of a bequest. Oftentimes, a church will receive a general bequest that is to the church itself, not to the endowment fund. And then it has to be a decision, well, what does the church do with it? It's unrestricted. They can spend it today, they can spend it all today, or they can put it in the endowment fund. What this policy says is the default position of the church is that all unrestricted bequests will go into the endowment fund. Unless, and then it has a process, the rector and the senior warden make a case for spending that money in the current year, and that there's no other source of funds for that. So it's a way to use the legacy funds that are coming to the church and to reserve them for future ministries of the church. There's an out clause saying, okay, if you make a case in the current year, you can spend it. But there's some churches that became very reliant on this bequest for annual operating. There's a church we helped recently, or a couple of years ago in Tennessee, that just got $1 million bequest last year. And they had this policy in place, which was very helpful. When the money came in, they knew what the process was. And so there wasn't a lot of conflict over it. They did make a decision to spend some of that money to reduce debt, and they put the balance, I think it was $1 million, they got $800,000, I think they put into the endowment. They took $200,000 and reduced their debt. So it's an open discussion, but this policy sets the stage. The designated gift policy has to do with donor restricting their gifts. And what you want to be careful not to do is to receive a lot of gifts of small size that are designated for a particular purpose. $1,000, $5,000 for flowers, $1,000 for the organ, whatever. Over time, you can get a lot of those little funds, and your treasurer is going to bless you, because they have to follow those, track them forever, and they're going to be there in perpetuity for those purposes. So what that policy does, it sets a minimum. It says for a donor to restrict the purpose, or just to define a purpose in their gift, it's got to be at least 20, 25,000, some say 50,000, some say more. The other policy, 2 policies that I refer to, is the spending rule, which is how money comes back out of the endowment. And what we encourage churches to do, and the UPMIFA law also encourages churches to do, or nonprofits to do, is to use a total return spending rule. And I'll elaborate on that a little bit more later on, because that's a very important concept to understand, and knowing the difference between what's considered an income-only policy and a total return spending policy. We recommend the total return, and I'll explain why that's important later. And the fourth one, the fifth one, the last one, is the gift acceptance policy. And this is simply providing guidance to the committee with regard to any non-cash gift, a gift of real estate, a gift of a life income gift, a gift of a retirement fund, how the church is going to handle those kinds of gifts that are non-cash gifts.
And Ken, if I could just add on to that, I mean, the gift acceptance policies and the ones which we provide are very useful, both for guiding the leadership of the congregation as well as guiding the donor. And that is why we would always recommend you make these policies very public, so that individuals within the congregation get a better idea of how best to give a gift, and also to build that sense of trust and confidence over the long term, especially when it comes to planned gifts. As I know Ken will mention later, I mean, it is imperative that you do build that sense of trust and confidence among the members of your congregation. And let me just say one last thing with gift acceptance policies, and that is it's a heck of a lot easier to say no to a bad gift when you have gift acceptance policies, because it is so difficult saying no to any gift that it might be given to you. But if you're able to point to a policy to say, no, I'm sorry, we can't accept that type of gift, or we have a policy for accepting it, which needs to go through the vestry or through another committee, that will protect you from things like the challenge of accepting a gas station or a dilapidated property or something of that nature. So I just wanted to add that to your what you were saying, Ken. Thank you.
Before I get into the investment, some of the investment conversation, a couple other startup considerations. One, I point this out carefully. When anybody starts an endowment fund with us, I want to make sure that the short-term reserve funds and the long-term endowment funds are separate. You do not want to mix them and invest them together. The long-term assets are invested with a long-term long-term strategy. Short-term funds should be invested with a short-term strategy, and they shouldn't be mixed. Another question that often comes up when a church is starting an endowment is, should we not spend any money out of the endowment until we reach a certain level? Like the church said recently, we're not going to spend anything out. We're starting with like $20,000. We're not going to spend anything until we reach $100,000 because it's not that meaningful. What's 4% of $20,000? It's not enough to have an impact. I would find I take exception to that, and I encourage them to spend, even if they have $50 that comes out of the endowment or $100. What it does is it establishes the process, that is, of determining who's in charge, how they're establishing that spending rule, how they're determining the funds available for expenditure, and reporting to the vestry, here's your money available for expenditure. But it also allows the vestry and the committee to talk to the church and say, last year we were able to spend $100 or $500 or $1,000 from our endowment, as little as the endowment is, but think of what it could be. And it's a marketing tool. It's a way to say, okay, we have it down. We've got the process in place. We are able to do this now, and we show through practical practice, what they can do. Also, they can show results. So I would say waiting until you reach 100,000 is not that meaningful. I think the benefit is far greater to actually spend it, even though it's a small amount.
Ken, a couple of questions had come up, and just to finish this section up on gifts, just to clarify a question that's been out there, any gift that is offered to the parish, whether it is a designated gift, whether it comes through an estate after someone has passed away or from a living donor, the parish always has the right to say no. You do not have to accept a gift unless you wish to. Once you do accept it, if there are any restrictions on the gift, you do need to abide by those restrictions. Someone else had mentioned that they had refused the gift of a timeshare, which is a very difficult gift to accept, and that would be a good example of saying no to a gift that is not as beneficial. So anyway, carry right on, Ken. Thank you.
Okay. The next point I want to make before I go to investing is about record keeping. You want to keep professional records, clearly. You want to have record of donor designation. If anybody makes a restricted gift, and too often it's in the head of the rector who he was told, or somebody, the senior warden, they said, here's a gift, I want to go in the but I want it to be used for thus. And then that is lost in history. You want to have a written record in the file that if a gift is restricted and designated by the donor, you want to have a written record that you can pass along to the next generation. You also want to be careful with the records. Oftentimes, these kind of gifts come with other personal records, such as plans for a funeral or their other personal information. So you want to be very careful to be confidential about what needs to be held in confidence. Certainly you want to acknowledge the gifts, and you also need to be careful about sub-accounting. I mean, it's a nasty little thing. You got to do it, but it's important to do in the long run because you want to know what funds are restricted, which ones are unrestricted, because that is influenced that influences what you can spend. And so you need to know which is which. And of course, the policies and procedures need to be in place and in a form that's complete and that can be passed along to the next group. So there's some record keeping that is important part of well-managed endowment. Going to the next subject, which is investing the endowment. We could spend hours on investments. I'm just going to touch on the broad decisions that need to be made by a church. That is, once you've established your endowment and you have some money that's there available to you, you need to make a decision regarding asset allocation. That is, well, where you're going to invest it, that's one, but your fundamental choice is going to be between stocks and bonds. You're going to, how much risk am I going to take on in the stock market? How much risk am I going to take on in the bond market? And it's helpful to have professional management because you are ultimately fiduciaries of this money, and you want to have a professional manager hopefully doing this on your behalf. Some of the decisions that factor into that are going to be your risk tolerance, your time horizon, and your need for withdrawal. Those are all decisions regarding that broad asset class decision between stocks and bonds. The second important aspect of it when you're talking to an investment manager is diversity. And FIFA law will recommend this as well, where it says you need to be well diversified within your asset classes. And by diversity, I mean within your equities, you want to have a mixture of, if you can, a large cap U.S. stock, mid cap, small cap, international emerging markets, international developed markets, so that you can take advantage of markets when they're going up and you're not as hurt by markets when they're going down. I mean, you see some of the, like for example, the emerging market stock is very volatile, so you may want to have a smaller exposure to that. But the markets, one year, I think it was 2009, right after the downturn, went up 70% in 1 year. And then it was the year before it was down like 60%. So you have a lot of volatility, but by diversifying your assets, you're going to spread that volatility over the entire portfolio. And you want to do the same thing with fixed income. You may have in the portfolio things like corporate bonds, treasury, agency debt, federal agency debt, high yield bonds perhaps, that's a little bit more risky, treasury inflation protected securities. So you have a blend of fixed income instruments, you have a blend of equity instruments. And then who does this on your behalf? Well, there are a couple of ways you can do it. One is you can work with some dioceses, have a diocese investment trust, and you simply ride along with their decisions. You're not making the investment decision. You have a finance committee at the diocese level that's making those decisions. You can go to a local brokerage and go to a local bank. Then you're more responsible for following those investment decisions. The Episcopal Church Foundation has an excellent program of investments where we invest on behalf of churches across the country. And the decision churches have to make in the under $1 million accounts is how much equities to fixed income do you want to own? That's the only decision. The rest of the decision making is made by the professionals at State Street Global Advisors, who is our investment manager. For those accounts over $1 million, you would develop your own investment policy statement, and your portfolio would be managed to your investment policy statement. But some of the broad categories of things to think about on investing, your investment objective is to preserve the spending power of the corpus of the principal. And previously, before the MIFA law came in, before that there was a law called UMIFA, which is the Uniform Management. Now they added the word prudent. But rather than consider what used to be called the historic dollar value of the fund, that is the original gift value, it's saying that isn't as nearly as important as the spending power of the fund. So when you consider your investment and you consider your spending, you want to marry them up. And you say, okay, we're going to do a total return spending policy. And I promised I would get into this. Where a total return spending policy is taking a rolling 3-year average, typically, of the net asset value of your fund. So one year it was $110,000, next year it was $90,000, next year it was $100,000. So over 3 years you got a $100,000 average value. And then you apply a percentage to that. Typically, we say between 3 and 5%, depending on market returns, what you anticipate the market to do, and your income needs. So say you're drawing down 5%. All right, so the endowment committee would tell the investor, you have $5,000 available for expenditure in the coming year from the endowment. And in a good year, you're still spending 5%. In a bad year, you're still spending 5%. So that what happens if, as in 2008, when the market went down, that loss or that decline was tempered by the fact that you had 2 other years prior to 2008 that were factored in that base. For the next 2 years after 2008, the core or the base was influenced to the negative by the 2008. But that way you soften the blow of a bad year by averaging it over 3 years, and you're taking a percentage. Now, right now, the average return or the average amount spent by endowments under 20 million is about 4%, 4% of a rolling 3-year average. But the purpose is to protect the spending power of that endowment over the long term. So you need to factor in what other things? Inflation and fees. So you're going to factor in the spending rate, say 4%, fees maybe 1%, inflation maybe 2%. So it's 4, 5, 6, 7%. All right, do you think you're going to get 7% return in the coming year? Well, if you invest it all in fixed income, there's no way. So that leads you to some conversation around your investment strategies. So you know you're going to have to have some investment in equities. Well, how much? How much risk are you willing to take? What's the possible return? And that's the conversation the endowment committee has when setting that percentage of draw over time. So you want to factor in the total return spending policy. If you were to spend only income, like some churches have done and get hung up on, what can very well happen is you have very little money to spend out of an endowment. $100,000 fixed income, you may be earning 1%, so $1,000. If you're taking a total return policy, you could have $4,000 or $5,000. Big difference. So you need to think about your spending rules as related to your investment strategy, as related to the ultimate purpose of the endowment fund. Sounds complicated, but it isn't that complicated. Other things about investments, some of the things that you want to look for, diversification of assets. Clearly, if you're going with a local brokerage house, you want to try to be as diversified as possible, because some asset classes will do better at certain times and others will do worse. So you want to be spreading your risk. You want to look for performance, and you want to have some measurement against benchmarks. Usually there's a standard benchmark. You have the S&P 500, you have the Barclays Aggregate Bond Index. There are certain benchmarks that you can throw up against your performance to see how well you're doing. You want to certainly have reports, and I would expect at least monthly statements and quarterly performance reports at a minimum, so you know how you're doing. You want to know about service. You want to make sure you pick up the phone, somebody's going to the other end to answer it. And then you want to be careful about fees. It's very easy to get lost in fees. Oftentimes you have an investment manager that's charging a fee, but then what isn't apparent is he's investing in mutual funds which have embedded management fees within each one of them. And those are not apparent. They're embedded so that they report performance after the fee is charged. So unless you ask or push or work at it, you may not know how much money is being charged against the fund fee side. So you can lose money in the fees, so be careful about that. What the Episcopal Church Foundation charges is about 1% for the funds under $1 million. For those over $1 million, it drops to about 80 basis points. The basis point is 1/100%, so that's 0.8%. And those are fairly standard. I mean, if you look around, those are, I think, rather competitive in the marketplace. but you need to take a careful look at fees when you're looking at your investment options. And the last thing I want to say, Jim, before I ask you to say something, this is I just went through this sequence about calculating the spending rule and then factoring in inflation and fees to come up with what that spending rate should be. Should it be 5 or 4 or 3% per year on the rolling 3-year average? And the last thing I would talk about is ways to grow the endowment. Endowments will grow primarily through bequest and a will, sharing life income gifts, and direct cash gifts. And by communicating clearly and often about the structure of your endowment, you're going to have a better chance of receiving those kind of gifts. Communication comes in many ways: church bulletins, newsletters, forming a legacy society, sharing information on the tools of planned giving, providing service to your church, explaining how to give, how to make a charitable gift annuity for the benefit of your church, and so on. All of these things factor into the importance of communicating effectively and often about endowment. And last, Jim, I'm going to ask you to say a few words about types of planned gifts, and then if we have questions, we'll try our best to answer them.
Well, if I may, Ken, and I'm going to just switch us back here, a quick question about income, and I know this comes up quite often when I'm talking with parishes about that they have an income-only endowment. Ken, can you just clarify the UPMIFA rules as they typically stand in most states when a parish has an existing income-only endowment, but can they consider using a spending rule instead now that UPMIFA has been passed in their particular state?
Yes, they can indeed. UPMIFA law says that even in the cases where the original gift instrument, say in the will, stated income only policy, income only spending, that the church can use a total return spending rule by following the prudent management guidelines that are embedded in the law. And by prudent management, some of the things it talks about, just what we talked about earlier: diversity, professional management, carefully calculated spending rules. All of that can be applied, and it overrules, UPMIFA actually overrules the income-only characteristic of existing funds. You can and fully are able to. In fact, you're encouraged to. Because of the distortion, if you think about it, you can understand the distortion that an income-only policy creates. Because it may force you, if you're going for income, you may try to invest in income-producing investments, which right now are relatively low, abysmally low, so you have very little return. Meanwhile, if you're investing, say you've invested your portfolio 50-50 and you're getting return on the equity portion, but very little return on the income portion, what happens is the corpus is growing, but you don't have money to spend out of the endowment. And so you're not fulfilling the purpose of the endowment. So that's why they say you can use a total return spending policy with a diversified portfolio and use what's called modern portfolio management.
Thanks, Ken. Another clarifier is with respect to UPMIFA, because this is coming up more and more. UPMIFA actually applies directly to true endowments, correct?
Only to true.
Correct. But do they also make suggestions for how to manage in the spending rules on quasi-endowments or those which are board created?
No, they don't, but I encourage it because I think the core principles of UPMIFA are well applied to all endowment funds, not just the restricted funds. They're just good rules and good policies to implement for managing all, and particularly if you're in the case where you're in a church where you have both restricted and unrestricted funds in the same endowment. That is, you can put it under one endowment and you can invest it under one investment strategy and have one fund. and then have a sub-account determining how much of that is restricted, how much is unrestricted. That's often the case in many endowments we work with. But you apply the overall principles of UPMIFA to the whole ball of wax. So you're coming out, you're good for your restricted funds, and you're well managed for your unrestricted funds.
Ken, I'm not sure if you already addressed it, but a question did come up about growth assets or grow assets. I'm not sure if, just to clarify, you were typically speaking in that case about equities. Then, if you're talking about assets which typically grow.
Yeah, the growth will occur primarily in the equity assets. Fixed income, there's not as much growth. You'll see some growth, but in a bond, for example, if you're guaranteed a certain revenue or return on that bond. If you hold it to maturity, it could decline in value over the life of the bond if you don't hold it to maturity. But you don't see a great deal of appreciation, capital appreciation in the bond market. You do see it in the fixed income market. I mean, look at this year. Through September 30th, I think the equity fund was up something like 19% year-to-date through September 30th. The fixed income fund was down 1.1%. So quite a contrast. And the long-term asset class forecast by State Street is that fixed income, at best, in the next 3 years, maybe 2.2% return, whereas equity assets more in the area of 6-7%.
Thank you, Ken. I also just wanted to underscore something you were saying under effective communications, because I really do think this is key. And when I'm talking about endowments, I always talk about, remember to talk about the impact, the difference. And you've been saying this all throughout your conversation tonight, that you need to demonstrate the difference that the endowment is making. If people get into the habit of just thinking of your parish as an endowed parish, and you're over-relying on the endowed funds for your operating income, and you're not making a difference in the world and in the lives of the individuals in your congregation, your annual giving will likely decline. And that's not what endowments are meant to be used for. They're meant to empower ministry and to uphold ministry both now and in the future. Ken, any final comments before I do a quick summary of planned gifts?
I would comment, I spent Sunday with a church who has a $2 million endowment, and their stated purpose, that they understand it, is they want to build that fund to $3 million and use it to underwrite the cost of the rector. They're concerned about not being able to afford a full-time rector. But they're finding it more difficult to sell that idea to the congregation because the congregation wants a broader purpose of the endowment than the full-time rector, and they feel like that should be coming from the annual operating budget of the parish. They want something more. And so they're really seriously rethinking about, is that what we want to define as the sole purpose of our endowment fund? And that's beginning of conversation, and we'll go from there.
Thank you, Ken. I just wanted to quickly summarize. With planned giving, planned gifts are the main way that endowments grow. Over the long term, it is through planned giving that most endowments grow. And you can listen to other webinars that we have recorded to learn more about this. But please know that the Episcopal Church Foundation is happy to assist you with all of its different resources to help you educate your leaders so that you can be better awareness raisers about planned giving. Because unfortunately, if you don't raise awareness that individuals at your congregation are able to leave you a planned gift, especially through their estate, through their will or trust that they have created, it's very likely they will leave the gift to someone else who did ask. And once again, I said this before, building that sense of trust and confidence among the members of the congregation is key. And it is through that you're able to build these planned gifts. And these planned gifts are crucially important to the individual giving them, because they're giving them out of their estate. They're raising you to the same level as their family, their children and grandchildren when they make these gifts. And you as leaders of your congregation have to demonstrate that you understand how important all of these different types of gifts are and that you thank people appropriately for them. And of course, that you spend the time in building trust and confidence. These are some of the basics of plan giving. You can learn them in our different webinars. We have a number of webinars which are recorded all on our ecfvp.org site, as tonight's webinar will also be. And I would invite you to visit that site. You can also contact any of us. We'll be sending out the link to our recording for tonight's webinar, as well as another set of our slides and some other resources for you to take advantage of. And please do contact us if there's anything that we can do for you. We are happy to be at your service. This is a part of our mission to build up the leadership of the Episcopal Church and to help secure its future. So for all of you tonight, thank you so much for joining us. Ken, I'll let you have the last word, and then I wish to say au revoir to our amis d'Haiti who are online with us today. And I know that Haiti, its nation and its people, have a very dear place in your heart. So the last word is yours.
We're going to be sending all of you the endowment policies and guidelines. Please take a look at them. They come as a Word document. You can modify them to reflect your own church's purposes and policies. But please send them back. I often will get into a dialogue with the church. I'm at your service. I will read and comment on those policies. I'll meet with you by phone, by Skype if need be. Feel free to call me at any time with your questions if you don't fully understand the spending rules or UPMIFA, how it applies, or restricted under any of those policies or concepts that we talked about tonight. I'm happy to engage in conversation by phone, by email. I do it all the time, every day, and I'd be happy to do it for any one of you.
All right. Well, thank you, everyone, for joining us. God bless. For all of our friends in Haiti, bonne nuit. And thank you. Merci beaucoup à tous. Au revoir. And thank you, Ken. Have a great night.
Thank you.